Are you looking at a chart that keeps flashing sell signals, watching the trend slide lower, and yet you still hear people calling it the absolute buy of the century? It makes you wonder if they see something everyone else is missing, or if they are just walking straight into a trap. Today we are breaking down Flex Ltd Ordinary Shares, trading under the ticker FLEX. If you trade derivatives or watch tech supply chains, this name has likely popped up on your scanners. Before we dive into the data, do me a massive favor. Hit that like button, subscribe to the channel, and drop a comment below with your current position. Are you holding, shorting, or waiting on the sidelines? Seriously, leave that comment right now because it helps the algorithm push this out to more traders. Let's look at what Flex actually does and why it is under a massive microscope right now. Flex is a global manufacturing heavyweight. They handle everything from automotive components to cloud infrastructure and healthcare tech. When the global economy shifts, Flex feels it immediately. Right now, the stock is catching eyes because of recent volatility, bumping around the $156 mark with a 2.4% move over the last 24 hours. But the real story isn't just today's price action. It is the massive tension between the technical indicators and the underlying valuation. If we open up the charts for a technical analysis, the picture gets complicated. The immediate trend direction shows clear signs of friction. We have seen short-term weakness creeping in, with consecutive sessions struggling to maintain upward momentum. Key resistance is sitting heavily overhead, and every time the price attempts to rally, sellers seem to step in to cap the gains. On the flip side, we are approaching a critical support zone. If this support holds, it proves buyers are still defending the asset. But if we break below this line, the momentum could accelerate downward rapidly. The moving averages are flattening out, which usually signals a transition phase. The big question is whether this transition leads to accumulation or a distribution phase before the next major leg down. This brings us to the latest analyst ratings and market signals. A lot of the short-term outlook models are flashing caution. We are seeing a mix of hold and sell signals pop up on quantitative scanners. Several analysts have adjusted their targets downward, citing compressed margins and slowing industrial demand. When you see technical sell signals aligning with fundamental downgrades, it usually gives institutional investors pause. They start stepping back, which leaves the price action highly vulnerable to sudden drops. The short-term sentiment is undeniably heavy, and the tape is telling us that the bears currently hold the steering wheel. This creates the ultimate trading dilemma. Is Flex fundamentally undervalued, or is this a textbook value trap? The bulls look at the price to earnings ratio and the company's massive footprint in the EV and data center spaces, arguing that the market is overreacting to short-term headwinds. They see a discount. But the bear camp argues that cheap can always get cheaper. A value trap happens when a stock looks like a bargain on paper, but changing macro conditions mean its future earnings will drop, making the current price justified or even expensive. If you're trading this, you have to understand the downside risk. Derivatives amplify everything. The volatility here means stop losses are getting hunted on both sides. Retail traders often get trapped because they buy the initial dip, thinking they caught the exact bottom. Then institutional volume comes in, pushes the price through support, triggers all those retail stops, and forces a liquidation cascade. Managing risk right now is incredibly difficult because the intraday swings are wiping out leverage positions before the broader daily trend even establishes itself. Let's lay out the bull versus bear case cleanly. The best case bull scenario relies on a macro recovery. If supply chain pressures ease and data center spending spikes next quarter, Flex could easily clear overhead resistance, squeeze the short sellers, and launch a massive recovery rally back toward yearly highs. On the flip side, the worst case bear scenario is a continuation lower. If consumer spending slows further and automotive production drags, the technical breakdown will intensify. We could see a swift drop past the current support floor, leading to a long, painful downtrend that forces a complete revaluation of the stock. Looking at the outlook, there is a massive disconnect between the short term and the long term. In the short term, the trend looks weak, the signals are negative, and the path of least resistance appears to be down or sideways at best. Long term, the company's structural role in global tech manufacturing remains vital. But as any experienced trader knows, a great company can still be a terrible stock if you get the timing wrong. You can be fundamentally right but still go broke waiting for the market to agree with you. So where does that leave us? We have a stock hovering at a critical inflection point. Technical screaming caution, analysts pulling back, yet a business model that underpins major global industries. Is the smart money quietly loading up heavily at these levels while retail panics, or is the floor about to completely fall out from underneath this trend?